In this video, we're going to talk about what is an OCO order. Stay tuned. Hey traders, a very warm welcome to you. So in this video, I'm going to talk about what is an OCO order and how we can use it to mitigate our risk in trading. So OCO stands for one cancels the other. And what I'm going to do is I'm going to run through an example as to when we might want to use that kind of order, and then let's just put an order through a platform and just see exactly how it would work in real life. So I've got up here US dollar JPY, US dollar yen. I've got a daily chart, so daily candles. I'm just looking here, and let's just say, for argument's sake, for this video, that I kind of come along and I'd said, okay, I think we've got a trend here, trend line here. We're above this 112 level. I want to take a short, so I go down on my lower time frames, maybe look at the hourly, and I would say, okay, yeah, it looks very nice. What would I do? Okay, I'd like to take a short here. Let me put my stop at 1350, and where's my target going to be? Let's go with that 1150. So I kind of got my ideas in my mind. Now you could be doing this obviously on your brokerage platform directly on the chart there. You can have your own charting package. It doesn't really matter. We're just packaging this trade together now and see how we'd use this OCO order type. So there, let me get that back up there. There we are. So that's kind of how we're going to frame this trade. And let's remove that trend line. So we're going to go, that's our target. We're going to have a target down there of 1150, and we're going to have a stop there at 1350, and we're going to go short whatever the market price currently is. Okay, so an OCO order is basically an order that says, okay, do you know what? One has to cancel the other. So if we go short here at the current price, which is 112.75, 756, 757, whatever it may be, and we enter a take profit or a limit buy, which will cover our short. Don't forget, if we're going short, we're selling something to cover that we're going to buy. Our limit would be 111.50, and then our stop will be 113.50 in this example. So an OCO order basically says one cancels the other. So if either of those are filled, then please cancel the other one. So what are the two scenarios that we could get here? We could take our short, and unfortunately we could be stopped out, in which case, as the market pushes up to this 1350 level, our stop would be triggered. Our buy stop would be triggered because we're short, so it's buying back at a loss. We close the position at a loss, close the short at a loss. This limit down here would automatically be cancelled after that stop was executed, so it's not left in. And then look at the other scenario, is that the trade goes our way, market drives down, comes down to 111.50, we get filled on our limit, we take our profit, the stop above us gets cancelled automatically as well. Now, why would we want to do that? Because the reason we want to do that is because we wouldn't want to leave a limit or a stop order in the market without any corresponding order. Well, there are some circumstances where you might, but no, for our all intents and purposes, you don't want to. If you're structuring a trade where you're in here, you've got a limit, you've got a stop, once the trade is done, you don't want any contingent kind of orders hanging around that are attached to that trade. And what would happen if you didn't have an OCO order, and if you just said, hey, listen, don't do anything once you fill one of these orders, don't cancel the other, then you would have that order left in the market. And let's look at that scenario now. Let's say, for example, we came down, market pushed down, you were very happy, you got your limit filled, you took whatever that is, 125, 28 pips out of the market, but this order is still left in the market. It hasn't been OCO'd, it's not been cancelled, it's still left in there. You forget about it. A couple of days later, a couple of weeks later, the market then pushes back up, goes through that 113.50. All of a sudden, now you're long at 113.50 because that stop order had that buy stop is executed, and because there's no corresponding short to cover it, you're actually now long. So, and you might have forgot about it, you might not want it, there's all sorts of reasons. So OCO order mitigates your risk. It allows you to put a bracket around your trade and say, hey, here's my entry, here's my exit, here's my exit if I'm wrong, here's my exit if I'm right. Either one of those gets triggered, I'm either going to lose money or I'm going to make money, and then that's it. Take all the other orders out and I'll look fresh. All right, let's dive into Trader, and let me see if I can bring it up here for you. And let's do one as if we're just going to put an order in actually on platform. So we're trading US dollar JPY, and that's, I know it's in the most popular markets. US dollar JPY rolling, that's exactly what we want. So we're going to hit the trade button. Okay, fire's up here. Now we know, remind ourselves, we're going to go short a market, and we're going to have our stop, what was it, 100 points away. I think we decided to have it at 113.50, hadn't we? So good thing about it is that we can just kind of see in where I've got my arrow here, as we adjust the level in terms of points where it would be, and let's put it a tick above that 113.50 level. So there's our stop, 76 points risk. Very nice, we're happy with that. Our limit now is, we were going to put it at 150, right? So that will, if we drive it down, oh, wrong way around, drive it up, here we go, got 10 more ticks, and that's exactly where we want to be. Let's put it a couple of ticks above it. So that's 125 points away, stop 76 points away, double check here to the high side, it's there, great, to the low side it's there. And obviously they're giving us, on InterTrade, they're giving us two different kind of scenarios, because they don't know yet whether we're buying or selling. And actually, the reason they have that is because they don't want to know if you're buying or selling yet, because there's a kind of old thing that the brokers would have to give you a two-way quote before you declare whether it's buy or sell, in case they manipulated that quote. So this kind of goes on for where we are now to technology. They give you a two-sided price, and there's, don't know what you want to do with that price, but that's the price you can buy at and sell at, and then you decide whether to buy or sell. In this example, we're going to hit sell. So we're going to sell here. We're going to double check the quantity we want. Let's say we want to do £5 a point. We're on a spread bet platform at the moment. We're going to go short at 112.78, 79, wherever we get filled at. Our stop is going to be, we have to adjust this a little bit, but I'm happy again to leave that just above that 113.50 level. So if we're short, that would be our stop. If we went long, by the way, then our stop would obviously be below the market and would be 112. But as we're going short, that's going to be our stop. So we check the red side corresponding with the sell, and also let's see where our limit's going to be. I'll take profits at that 111.50. Great, sell it. We're in. So trade price filled, £5 a point, 112.79.8. Our stop level is 113.5 or 52, and our limit level is 111.54. If we go back to our chart, double check what we had here, pretty much what we've got, 113.50. Great, we'll stop there. So those are going to cancel each other out. If one of them gets filled, then it's going to automatically cancel the other one, and basically the trade just gets bracketed nicely. We can forget about it and we can look on to the next trade. You don't have to worry about when it's going to get filled and if it's going to be a loose order just left around the market that couldn't make us net long or net short. So that's an OCO order, guys. Very useful to do. Now, just a little tip is that, hey, you don't have to kind of always use that to get in and out of your trade, but if you've got it there, if you've bracketed your trade, you've captured risk, which you should always do anyway, you've got a kind of primary or an overall ultimate target, should I say, you can always adjust it and move it around and take profits early or stretch it. Stop, you should probably always keep it in the same position, but you can adjust it. But at least you've got that bracket in place. If something comes out and the market suddenly spikes in your direction, at least you've got a resting order there to capitalize on that opportunity, grab the profit, bank, crystallize that gain, and move on to the next one. All right, guys, good trading. See you in the next one. Take care. Bye bye.